You're back with America's Forum on Newsmax TV. I'm J.D. Hayworth, and wow, we've got our pal Howie Carr here from Boston, live and in the flesh. He's right here. He's tangible. I can grab. I better watch it. I don't want to get slugged here. But of course,
I'm not Skyping today.
You're not Skyping. He's
no
right here.
snowstorms in the background. It's great to have you here, Howie.
It is very good to
be
have
here.
you, Howie.
All right, real quick, let's turn our attention right now to some financial matters. Last week, the stock market was left reeling when the NASDAQ, the Dow Jones, and the S&P 500 were all hit by big sell-offs in biotech and internet companies. The sell-offs were spurred by a fear that current market valuations of the companies are extremely exaggerated. The pullback underscores concern over the broader outlook for share prices following a 30% rise in the S&P 500 last year. Investors are selling riskier investments and purchasing what they see as safer alternatives: dividend-paying utilities, consumer companies, and pharmaceutical firms. Experts expect stocks to bounce back, maintaining steady economic growth. Low interest rates and accommodative Federal Reserve monetary policy can also help in the money growth. Of course, a lot of folks wonder if that growth is real. Joining us right now is the author of the Six Keys to Financial Success and the editor of the Ultimate Wealth Report, Sean Hyman. Sean, it's great to have you here with us.
Hey, good to be with you.
All right, so we were talking about this sell-off last week on all three of the major U.S. indices, the S&P, the Dow, and the NASDAQ all lost big year last week. But it's hard, Sean, almost to get excited about a 1 or 2% drop in these markets anymore because we see them happen so frequently. So is this par for the course, a simple market correction, or are there other factors here contributing to what could be a long-term bear market?
Well, it possibly is just a near-term market correction, but I say that with a bit of caution because, you know, on one hand, the Fed has delayed their plans to hike rates, and so that kind of gives the market participants a bit of an excuse to push the markets back up again. But the caution part of it is the price to earnings ratios of the stock market are historically on the high side now. So the risks are high, the reward is low, and so the chances of a 10 to possibly 20% correction are now high, and with maybe 2%, 3%, 5% upside left. So the reward is now dismal compared to the risk that we now face in the market, and that's the big concern.
Sean, as we're dealing with this, it almost seems a case study in psychology as well as high finance, the way different guys are feeling about the market and is it overvalued. And Sean, I think a lot of people, to put it bluntly, are fed up with the Fed, and even that may not be as blunt as people's behavior really is. Sean, if you were going to correct the woes we are encountering right now in terms of systemic challenges economically, what would be your to-do list? 3 things that you believe should happen right now to really get us on the path to prosperity.
Well, really, I mean, in my opinion, it boils down to really 2 things. I mean, one, you've got to have the Fed highly incentivize the banks to get out there and lend money. And so right now what's happened is the Fed has put money into the banks, and the banks have turned around and put them in conservative instruments like treasuries and things like that to rebuild their own balance sheets, which they've done. But the problem is that doesn't help the small business person or the individual or anything like that. So it doesn't really grow the economy. It just helps the balance sheet of the bank. So, you could go to things like a negative interest rate where you charge the banks interest, and that would get them incentivized to get money out in the form of loans to the people, to small businesses and individuals, rather than having to pay interest on their excess reserves. So that's one. And 2 is more along the lines of Congress giving big corporations incentive to repatriate money home. I mean, there's like $1 trillion out there in foreign lands that we could bring home a good portion of that if there was a favorable tax incentive for them to do that. And so if we would just kind of come in line with a lot of the rest of the world, they would be happy to do that. So those are the 2 biggies that I see, really.
Sean, this is Howie Carr. What about the fact that basically the Fed hasn't raised interest rates for 5 or 6 years? We've had 0 interest rates. I mean, doesn't this distort the values in the stock market? I mean, how do we know what the real values are once they start allowing the interest rates to rise?
Well, and it is creating a bubble, basically, is what it's doing, and that's why a lot of hot money has gone into things like social media and biotech stocks, and it's getting very risky. It's why the NYSE margin levels are as high as they are. They're at all-time highs right now, higher than the crash of 2007, higher than the crash of 2000. And so the biggest risk that the Fed runs in being very loose like that for that long It allows speculation to run rampant and people to be more willing to go out on the end of the limb. And that's what really drives stock market valuations up to historically high levels and sets you up for the next crash. So that's the real danger there.
And so, Sean, what you're saying, and I'm just going on based on your last comment, this bubble we're in currently right now, you see more danger here than 2000 and 2007.
Correct, absolutely. Just off of the NYSE margin levels alone, it proves, it's a tangible proof that investors are more extended now than at any point. And at a certain point, all their buying power dissipates, and the least little bit of tumble will start to cause more corrections.
So Sean, with this situation, what are the marching orders? If you're giving advice, you just tell people to get the HE double hockey sticks out of stocks right now, or what?
Well, no, what we're doing in the Ultimate Wealth Report is telling them to be extremely picky about what you do invest in. So go to everything that has been shunned, that nobody would want to, really shake a stick at right now. And so it's the stuff that's the low PE out there. So it's some of the beaten down oil companies, it's some of the beaten down natural gas companies, it's a lot of the commodity and emerging marketplace, the things that are at like single digit PEs that have not been inflated, that have not followed the trajectory of the stock market, that are the places where institutional money will need to roll out of and go into these type names, because institutions can't just go into cash, they have to be somewhere. And so they'll roll into the lower risk, low PE names, and that's where it has to be found. So it's really a stock picker's market right now.
Sean, do you blame people? A lot of people like myself have been out of the stock market for a number of years now. I just feel like I can't. It's a roulette wheel. I'm not. It's like going to a casino. I don't want to do it. Do you blame people for staying out of the market during this historic rise?
Well, I don't blame them, especially if they're close to retirement, because so many of the investing public out there are either close to retirement or they're the baby boomers that are starting to go into retirement right now. So they have to be more cautious. They can't say, hey, I don't have 5 or 10 more years to try to get it right. I've got to get it right in the next year or 2 or 3. And so they have to pare back the reins and take a more conservative approach. And so in that instance, I don't blame them. And the other, though, if somebody has more time than that, I would say, just go into stocks in a very educated manner like we do in the Ultimate Wealth Report and make very prudent decisions with very properly priced stocks, even undervalued priced stocks.
Well, and you mentioned the title. It deserves amplification, Sean. Take a look at the book, and again the title, The 6 Keys to Financial Success. And there you see the key. You can't judge this book by its cover because it's fairly obvious. There's the key right there, along with the title. Sean Hyman, we very much appreciate it, and of course also the fact that you edit the Ultimate Wealth Report. We look forward to our next visit as you monitor and explain to us the mysteries of Wall Street and how it affects Main Street and maybe the street on which we live. Thanks so much for your time.
Hey, thank you. I appreciate it.
Well, Howie, you mentioned a good point. I mean, it's so infuriating to try and follow the stock market now, especially when you listen to a lot of financial journalists talk about this stock and that stock. The market's up. It's exhausting.
Yeah, you don't know if you're dealing with somebody who knows what they're talking about or a snake oil salesman.
Which is why it was so good to have Sean Hyman, who knows whereof he speaks in terms of public policy and what is happening on Wall Street and elsewhere. Hey, when we come back, the saga of the International Space Station, there's got to be a food run despite the failure of a computer. All that's ahead on America's Forum.